So, what if I told you a company could boost its stock price without actually selling a single extra product? Sounds kind of weird, right? Well, it happens all the time. It's called a share buyback. And it brings up a huge question. Is it a sign of a really healthy, confident company? Or is it a major red flag that they've just run out of good ideas? Let's dive in and figure it out.
At first glance, it really does feel like some kind of corporate magic trick. I mean, think about it. A company just spends its own money to buy its own stock, and poof, every share that's left suddenly seems to be worth more. But it's not magic, not at all. It's all about financial mechanics. And honestly, they're surprisingly simple once you see how it works.
All right, so first things first, what exactly is a buyback?
Well, it's pretty much exactly what it sounds like. A company has some extra cash lying around. Now, instead of, building a new factory or launching some huge new ad campaign, it just goes out onto the open market and buys its own stock. So, what happens to all those shares the company just bought? Well, they're basically taken out of circulation. A great way to think about it is to picture the company as a big pie. By buying back shares, the company is literally reducing the total number of slices available out there. In fact, it's the complete opposite of what a company does when it needs to raise money. When they issue new stock, they're adding more slices to the pie, which dilutes everyone's ownership. A buyback does the reverse. It removes slices, which concentrates the ownership for everyone who's left. At the end of the day, this whole thing is about one goal: returning value to the shareholders. Now, the old school way was a dividend, a simple cash payment. But buybacks have become this super popular modern alternative. So you gotta ask, why the big shift? What makes them so attractive to companies? Okay, let's start with the bull case. Why is this seen as such a good thing? Why do so many companies and investors absolutely love buybacks? It really boils down to three main benefits. First, there's the math. It gives a nice boost to a super important metric called earnings per share. Second, it can be a really smart move when it comes to taxes. And third, it sends this powerful signal of confidence out to the entire market. Now, that first point about EPS, that's probably the most powerful argument in favor of buybacks, and it's all just simple arithmetic. Let's walk through an example and see how slicing that pie a little differently can change the whole picture. All right, so let's imagine a company. Say it makes a cool $10 million in profit. And let's also say it has 1 million shares floating around on the market. The math here is easy, right? You just divide the profit by the number of shares, and you get what's called earnings per share, or EPS. In this case, that's $10. Okay, now the company decides to take some of that cash and buy back 100,000 of its own shares. So the total number of shares out there just went down. And here's where it gets interesting. Look at this. The company's profit is exactly the same, $10 million. They didn't invent anything new, they didn't sell more stuff. But because there are now fewer shares, that same $10 million in profit gets divided by a smaller number, 900,000 instead of a million. And boom, the EPS jumps to $11.11. So think about what just happened. Without the business getting fundamentally any better, the company looks more profitable, at least on a per-share basis. And this is a huge deal. A lot of investors use EPS as a key way to value a stock, so a higher EPS can lead directly to a higher share price. And it's all because each shareholder now owns a slightly bigger slice of that exact same pie. The second big win for buybacks is all about taxes. See, if a company gives you a dividend, that's cash in your pocket, and you've got to pay income tax on it right away that year. But with a buyback, things are different. Your shares might go up in value, sure, but you don't owe a dime in taxes until you actually decide to sell them. And even when you do, it's usually taxed at the lower capital gains rate, not your higher income tax rate. That's a big difference for investors. And finally, there's the signal it sends. I mean, think about it. When a company's own management team decides to use billions of dollars of corporate cash to buy their own stock, they are making an enormous bet on themselves. It's like they're shouting to the market, hey, we've looked at all the places we could put this money, and we've decided the very best investment on the planet right now is us. But that's only one side of the coin. There's a whole other way to look at buybacks, a much more critical view. This is the bear case, and it asks a tough question. Is that powerful signal of confidence just masking a much deeper problem? And this really gets to the heart of the criticism. When a company looks at its huge pile of cash, and the best idea it can come up with is to just buy its own stock,
does that mean it has completely run out of ideas for real, actual growth? You see, critics look at that pile of cash and they don't see a smart financial move. They see a massive wasted opportunity. That money could have been the fuel for genuine growth. It could have funded groundbreaking R&D, it could have been used to acquire a brilliant competitor, or to upgrade factories and become way more efficient. Instead, it was used to shuffle paper around. So, from this point of view, a buyback doesn't create any real, tangible value. It's not making new products, it's not finding new customers. It's seen as just financial engineering, a short-term trick to make the numbers look good, hit those quarterly earnings targets, maybe boost executive bonuses that are tied to the stock price, all without doing the actual hard work of innovating and growing the business. So here you have it, two completely opposite views. On one hand, the bearish case. A buyback is a short-term fix from a company that's out of steam. On the other, the bullish case. It's the most responsible and disciplined use of cash when you truly believe your own stock will give you the best return. Which one is it? So, where do we land? After hearing both sides, what's the verdict here? Is a buyback a brilliant move or a really bad habit? Well, the truth is, it's not that simple. The real answer depends entirely on why the company is doing it. It really all comes down to context and the specific situation. For a big, mature, stable company that's just generating more cash than it can possibly reinvest wisely, a buyback might be the most responsible thing to do. But for a young, hungry company in a super competitive field, a buyback could be a really dangerous signal, a sign of a serious lack of ambition. And that, right there, is the real risk. Look, a buyback can be a perfectly legitimate financial tool, but it can also be, as the Alternative Market Guide puts it, a sign of a company that is out of ideas and overvalued. So the real challenge for any investor is figuring out which story is this buyback telling. So the next time you see one of those headlines about a company announcing a massive share buyback, just pause and ask yourself, is this a sign of rock-solid confidence or a total lack of imagination? Is it a bold bet on the future or a quiet admission that all the best ideas are in the rearview mirror? The answer to that question can tell you pretty much everything you need to know about where that company is really headed.